If you have stocks, bonds, or other investments you need to report on federal and state income tax returns, you want to hear this show. You want to watch this show till the end. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you're to ask me. If you are doing as superb as I am, go grab a cup of coffee or tea or vodka and let's roll. Today's conversation will be around reporting stocks, bonds, and other investments on federal and state income tax returns. So unless your investments are in a retirement account, say an IRA or a 401k, you will have to report all of your stock transactions to the IRS every year, right? So if you live in one of the 43 states that assess state income taxes, you'll also have to report your trades to your state. So profitable stock trades will result in taxable gains, whether short-term gains or long-term gains, capital gains. If you held your stocks for longer than 1 year, you will benefit from the lower capital gains tax rate rather than your ordinary income tax. So I'm going to give you 10 steps that you need to follow to report stocks on federal and state income taxes. Number one, you want to gather your 1099s. So if you make stock trades during the year, your financial services firm will send you a Form 1099-B at the end of the year, along with all the relevant information for your taxes. So you'll get one 1099-B from each firm where you placed a trade. So you'll need to wait until you get all of your 1099s before you can correctly file your taxes. The second thing you need to do is you need to divide trades into short-term and long-term. This is very important because the timing factor here has significant consequences when it comes to the amount of taxes you need to pay in the end. Since long and short-term trades are taxed at different rates, you'll need to segregate your trades by your holding period. Short-term trades are those held for 1 year or less. Step number 3. I want you to gather information that is not on your 1099s if required. Let me give you an example. Financial firms starting about a decade ago, 2010, financial services firms were required to keep cost information for trades and report this information on 1099s. If you've held a stock since before 2009, your brokerage may not have all the relevant information on your trade, such as your cost basis or date of purchase. So you'll need to come up with this information from your own records if you do have them. Step number 4, and this is very critical, folks. I want you to check the appropriate box on Form 8949. We're showing you a screenshot of that form now, along with the link where you can download it from the IRS website. So Form 8949, sales and other dispositions of capital assets. So if your transactions were reported on Form 1099-B, including basis, you want to check box 8. So if the info comes from Form 1099-B but does not include cost information, you want to check box B. So if your trades were not reported on Form 1099-B, you must check box C. So you need to enter stock information on Form 8949 per the IRS instructions. Remember that you need to actually provide the name of your stock, your cost, your sales proceeds, and the dates where you bought and sold those instruments. Short-term transactions go in part 1, while long-term transactions go in part 2. So we're going to put again the form on the screen so you can see it. If you need to adjust your gain or loss, you'll have to provide a code to the IRS informing the agency of the reason for your adjustment. Then step number 5, you need to transfer information to Schedule D per the IRS instructions. Remember that capital gains and deductible capital losses are reported on Form 1040, right? Schedule D. And and then they have to be transferred from there to line 13 of Form 1040, U.S. Individual Income Tax Return. One thing, just as a reminder, capital gains and losses are classified as long-term or short-term. So if you've held the assets for more than 1 year, your capital gain or loss is long-term. If you held the asset 1 year or less, your capital gain or loss is short-term. And one thing I want to say is that all this might sound a little convoluted to you. And listen, I get it. This makes sense if you think it's too convoluted. There are nowadays, thank God, there are nowadays apps and the tax software that automate everything. You don't have to enter each stock, especially if you're a day trader. That's a killer, right? If you're a day trader or a swing trader, and you are placing you've placed thousands of trades during the year, you don't have time to do this. So there is software or apps that actually automate everything and makes your life easy. So depending on the app or tax software you chose, you have that option where you can just export. You can export your trade placed, your stock information, your bond information from your broker, say Robinhood or TD Ameritrade or Charles Schwab or Fidelity, onto your tax software. And the system, the integration between your brokerage and the tax software works in such a wonderful way that you will just need to, the system will automatically calculate the capital gains or losses for you. So speaking about calculating capital gains and losses, in case you have to do it manually or just FYI, because you still need to understand how things go behind closed doors, behind the scenes, right? If the software is doing it for you, you still need to understand, because God forbid the IRS sends you a letter of information or you get some kind of a letter, you need to understand what the agency is talking about. So it's important to understand how to calculate your gains and losses. So you need to follow the instructions for Schedule D to total your short-term and long-term gains and losses. One thing that's very important when it comes to gain-loss calculation is basis. So what is basis? Let's understand basis here. The difference between the amount for which you sell the capital asset, aka stock, bond, and your basis. So the difference between the amount you sell the capital asset and your basis, which is usually what you paid for it, is a capital gain or a capital loss. So generally, it's very simple. You have a capital gain if you sell the asset for more than your basis, right? Sounds very logical. And you have a capital loss if you sell the asset for less than your basis. Your basis, come to think of it, is generally your cost plus improvements. And you must keep accurate records that show your basis. So your records should show the purchase price, including commissions, increases to the basis, such as stock price increases, and decreases to the basis, such as stock splits and non-dividend distributions on stock. Again, the cool thing here is that nowadays, with the advent of the fintech companies such as Robinhood and others, the whole industry has automated a lot of stuff. So you don't have to keep those records anymore manually. The system should be doing it for you. Now, while all capital gains are taxable and must be reported on your tax return, only capital losses on investments or business property are deductible. Losses on sale of personal property are not deductible. All right. And what about investment transactions? So gains from sales and trades of stocks, bonds, or certain commodities are usually reported to you on Form 1099-B, right? I said that before. And your basis, the sales price, and the resulting capital gains or loss is entered on Form 1040, Schedule D, capital gains and losses. And capital gain distributions from mutual funds are reported to you on Form 1099 DIV, dividends and distributions. And capital gain distributions are taxed as long-term capital gain, regardless of how long you've had owned the shares in the mutual funds. That's a special rule when it comes to mutual funds. If capital gain distributions are automatically reinvested, the reinvested amount is the basis of the additional shares purchased. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We are still having a convo here about how to report stocks on federal and state income taxes. Now, step number 7. Once you have calculated your gains and losses, I want you to transfer information to Form 1040. So for short-term gains or losses, you want to transfer the info to line 13 of your Form 1040. And since long-term gains are taxed at a lower rate, you will compute your tax using the Schedule D worksheet before transferring the tax amount to line 44 of your Form 1040. Step number 8, you need to copy federal information onto state tax returns if required. Now, again, if you're using tax software or tax app, those things are done. The transfer is done automatically. But if you are just doing things manually, you need to copy the federal info. So while the details of state tax forms vary, states that levy an income tax typically only require the raw data, such as your adjusted gross income from your federal return. You will not have to enter all of your individual trade information again on your state tax forms. And number 9, you need to understand what triggers IRS audits related to stock reporting, stock or bond or mutual fund reporting, investment reporting. And as an investor, you need to be on the lookout for discrepancies in the following areas that might make the IRS sit up and take notice of your return. Number 1, things like missing dividends and interest. So if you forget to include all of the dividends and interest from your banks and brokerages, guess what? This could make the IRS curious, especially if the amount is material, the amount is significant. But even if you have made an error, you might not need to sweat, right? You just want to correct things very easily. The IRS may simply correct the deficiency and deduct the extra from the return you filed, or if the tax exceeds your refund check, you'll be asked to cough up more money. But the cool thing here is that the IRS may not look so kindly on a much larger 1099 that goes missing because, hey, guess what? The unreported income could possibly trigger a further in-depth audit. So you really want to take care of things very quickly and make sure that if you made a mistake and the mistake is non-intentional, it's about a small amount, okay? But if it's a biggie, then you might get in trouble. So besides missing dividends and interest, you also have missing capital gains. Missing capital gains could also trigger an IRS audit. And then you also have misfiled employer stock options. And then the last one is filing late. So if you have missing dividends and interest, if you have missing capital gains, if you have misfiled employer stock options, or if you filed late, those are elements that could trigger an IRS audit. Let's talk about missing capital gains. If you sell a stock or other security and you have earned a profit on it, congratulations. But now guess what? You have a capital gain, right? So you will likely owe tax on that gain. And the rate depends on whether you held the security for more than a year or not. So taxpayers generally note a capital gain on Schedule D of their return, which is the form for reporting gains or losses on securities, right? So if you fail to report the gain, the IRS will become immediately suspicious. Don't even think about it, because the IRS may simply identify and correct a small loss and ding you for the difference, a larger missing capital could get you in trouble. Same thing as the dividends and interest, right? Same logic here. So the one thing I want to say is that do not assume that you can skip reporting a capital gain because the broker's year-end tax report was delivered late. No. If you filed your taxes too early and don't report the gain, you'll have to file an amended return and explain to the IRS what happened. What about misfiled employer stock options? So let me just say this. The tax issues surrounding employer stock options can be tricky. Very tricky. In many cases, employees are reporting little to no gains on them, so they may think they don't need to report it. In fact, it's common for the taxpayer to not report the sale, but that's a big no-no. Very, 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 very. This is a huge no-no. Don't do this. Here's what happened. Let me just break it down for you. An employee may be granted options as a perk, right? When employees want to exercise those options, they put up the money and buy the stock at the agreed upon price. Many times, employees will simply turn around and sell the stock. However, they often fail to report the exercise price of the options, which is the correct cost basis for figuring the taxable gain. So you have to really think about that. And filing late. So the IRS wants to be paid and it wants to be paid on time. So that can be very difficult for investors sometimes, especially when some investments may be especially complicated or year-end statements may arrive very late in the tax season. In fact, it's very common for some companies to report tax information into April or even beyond the April 15th tax deadline. So while an investor's tax return may be more complicated than the average return, the agency still wants a timely filing. All right. So if you don't do it, you might actually stay on their radar, and you can attract attention. So you really want to file. You really want to file on time, or you can request an extension, but at least make the payment by the due date. And last but not the least, again, folks, I'm talking to you about how to report stocks, bonds, or other instruments on federal and state income taxes. And I've actually I've laid out the foundation of this show through 10 steps, and this is the last step. You need to know what to do when the IRS contacts you for information on your investment reporting. Very important. You don't have to freak out. Don't freak out. If the IRS contacts you, the first thing you need to do is to stay cool, right? Keep in mind, just because you are subject to audit, it doesn't mean your return is incorrect. So in addition to properly filing your return and including all your income, as an investor, you have other steps you can take to avoid the taxman calling. So, simple things can keep you from an audit. I think I already spoke about that. So dividends, missing dividends and interest, capital gains, misfiled employer stock options, filing late. Those are very important things. If you want the IRS not to notice you, you really want to actually take care of those things. And you also want to avoid claiming illegitimate deductions that don't apply to your situation. Now, if you do apply for a deduction that is unusual, you want to actually include a letter of explanation with the return. It's not bulletproof audit protection, of course, but it will begin the documentation process that may head off an audit before it even begins. So if for the last 20 years you have never taken a certain deduction, and all of a sudden you take that deduction, you want to explain to the agency, to the IRS, why you are this year choosing this, you are actually claiming that deduction. And for those, for example, for those who are investing in real estate, you want to keep track of all your rental expenses and deductions. Very important. And finally, folks, just because you have a large deduction doesn't mean you should not claim it, even if you think it looks a little unusual. Again, if the deduction is huge, I'm talking here about the monetary size, or it's unusual, well, go ahead and claim it. Just explain things to the IRS; they will understand. You need to be able to back up the numbers that you have put forth to the IRS. Substantiation is key to winning an audit. You need to be able to prove everything. So get your paperwork, get your receipts, get everything that can actually substantiate the deductions that you are claiming. Very important. And one thing I also want to say is that you also want to pay attention to if you are, let's say you're buying securities that are not publicly traded, right? So if the securities are publicly traded, everything is fine because the losses for the stocks will be included on your broker's tax statement. But if you are in a real estate investor, this may not always be the case, right? For property investments. So make sure that you hang on to receipts from a variety of stores or independent contractors who have worked on your property to make sure you can, again, substantiate everything. All right, folks. This is it for today's conversation. I really want to thank you. And I was just talking to you about how to report stocks on federal and state income taxes. I actually went through 10 very quick and easy steps you can follow to make sure that you do everything properly and you can head off any possible audit into your financial affairs. So number one, you want to gather 1099s to divide trades into short-term and long-term. You want to gather information that is not on your 1099s. You want to check the appropriate box on Form 8949. You want to transfer information to Schedule D. You want to calculate your losses and gains, your capital losses and gains, or short-term losses and gains. You want to transfer information to Form 1040. You want to copy federal information onto state tax returns if required, very important. You want to understand what triggers the IRS audits related to stock reporting, investment reporting, and you want to know what to do when the IRS contacts you for more info on your investment reporting. The idea here is not to freak out. The idea is to keep you cool and just respond to the conversation the agency started. All right, folks. Thank you so much for your attention. Really appreciate it. I will see you next time. But until then, remember, stay marvelous.